Yes, good afternoon, people online. So, I think we were discussing about the initial stuff on ratios. Okay. So, the main focus was on who, the point that we were discussing was who will be doing the analysis. Right. So, who all will be doing the analysis? Hmm. Huh? Management, then, then customers, research analysts, regulators, huh? Credit rating companies, credit rating agencies, suppliers, etc. Okay, so we said like these are the people who will be doing the analysis. And the point that we were discussing was what is it they will be looking for, right? Who will be looking for, and or what is it they will be looking for, right? And then we were also talking about different stuff. So in that, main thing that we were talking about was profitability, right? And how profitability is one key, and like different people look at different things. So customers, I think the point was we were looking at inventory. Bankers, we were looking at the debt level and also the profitability aspect. Okay. So like that, different people are looking at different stuff, but generally, and also I think one of the key stakeholder is your regulator, your employees. Generally, all of them will look at profitability. Okay, and I think for shareholders, we were talking about dividends and net worth. So we know different terminologies for net worth as to how my net worth changes, and more also value addition. Right? These are the things we were discussing, and then we also started looking at the P&L statement, right? Different components of profit and loss account, and we were looking at how your profit and loss is prepared, why it is not sufficient to look at net profit alone. Like if I give you company A, company B, why it is not sufficient to look at net profit alone, like 500 and 600. We cannot say that company B is better than company A, or company A is not better than company B. We need more details, right? So we'll keep this aside. What we are trying to understand in terms of your financial statement analysis is who will be doing the analysis and what is his perspective, right? It will be two things: who is doing the analysis, and for what purpose, right? Same purpose, same person can do the analysis at a different time for different objectives. Accordingly, the analysis will differ, right? So, but when someone is looking at the company, they are looking for few things always, right? Which those things we have discussed here, and some things we have not yet discussed. So the other day there was a point on customers as to what this fellow will be looking for. They said inventory, and I said that there could be more points. Similarly, what is it that the suppliers will look for? What is it that the suppliers will look for? Payables.
The
Receivables.
repayment capacity.
Payment capacity, very good. Payable days, okay. So basically, these two people will look at liquidity. Right? Effectively, whether you can supply or not, whether you can repay or not, whether you can, whether do you have so much of inventory, what is your credit policy, all of that is summarized in liquidity. Right? This is what they will be looking at. And this is basically more of short term. Like to do business in short term, at any point in time, liquidity is important. Right? Today, for short term, like say for me to survive next to 3 months, liquidity is important. Say 2nd of July, 1st of July, again for next to 3 months, liquidity is important. So liquidity remains important for every short term. Right? And for me to succeed over long term, my short term period should also be good enough. That means I should be properly liquid. Getting it? And it is not only these two people look at, bankers will also look at your liquidity. Even though they don't focus much on liquidity, but still they look at it. Right? Lenders and bankers will also look at your liquidity. Liquidity can make you or break you. During COVID, a lot of businesses closed not because they were not having demand. Right? It is because they were not able to procure. Why? Because their payment was not coming on time. Basically, liquidity issues. Because you are not making my payment, I am not able to make the payment to my vendor. So this was like chain reaction across the economy because of the lockdown, and even after the lockdown for 2-3 months, it continued for 2 years. The chain reaction, and those companies survived, those businesses survived, whose liquidity was reasonably good. Why? Because they were able to manage this short-term crisis, right? They were able to retain employees, pay them salaries. They were able to retain customers. They were able to give on credit. Why? Because customer is not able to pay. You still went ahead and gave on credit. There are so many examples where people have given credit for 1 year, 2 years, especially during COVID period. To the customer, I'm capable, fine, take it. Right? I'll give you credit this time. Manage it for 1 year. So that means he has become a customer for me forever. Right? So because now how I will be able to do, if I have that capability, if I have the capability to have sufficient inventory, if I have capability to pay, if I have the capability to manage my expenses, if I have the capability to manage my employees, right? If I have the capability to sustain without getting any payment for next 12 months, 2 years. So that means liquidity also becomes very crucial. We will see that liquidity is many times more important than profitability. Right? At times you may go without profit, but you cannot say I am not liquid. If you're not liquid, you're not able to do business at all. That is what it means. Right? You're not able to find the right opportunity. So profitability, liquidity is also more important than we have looked at network. So there, like that, there are 4 or 5 things that we look for. Okay. So one is profitability, other one is liquidity, and then few more things which we'll be looking at as we go into. Okay. So before we start the analysis, as I said, for analysis, what we do compare. We do comparison. Right? And to give a metric to this comparison, right? To give a measure, to quantify this, right? What we use is called ratios. What are ratios? What are ratios? Why do we use ratios? What and why? Two questions. Rate of change between two variables. Very good. Rate of change between two variables, then good, then. So
The
this is
ratios
utility,
are
okay.
sir, ratios are method of analyzing companies' financial data in quantitative terms.
Come again, method of
Analyzing companies' financial data in quantitative terms.
okay. This is, we are not telling ratios in the context of financial analysis. Generally, what are ratios? Okay. Now look at what is it. We all know, we have seen it. Basically, it is a mathematical representation, okay, of two different variables relative to one another. Correct? It is a mathematical representation. Okay, that means you are quantifying it. So mathematics is involved, right? The the underlying nature of the data which you are representing in ratios, which is represented in the ratios, is removed once represented. What does this mean? Looks very complex. Very simple, right? 100 rupees, 5 kgs. No rupees, no kgs. It is purely a number once it becomes a ratio. Right? You express only in either percentage terms or in terms of times. Either percentage or times. 1 time, 2 time, 3 time. Correct? So what does this mean? What is the effect of why are we using these ratios in the financial analysis? Is so that tomorrow I can compare a company which is having a net profit of 500 and another company which is having a net profit of 50,000. How do I compare? Now looking at this, I cannot compare. But if I put the revenue here, revenue is 3,000 and revenue is, let's say, 5 lakhs. I cannot compare, I cannot say company A's revenues is less than company B's revenue. I cannot say company A's profit is less than company B's profit and say that company A is not good and B. Why? Because the sheer size is different. You cannot compare it just like that. But if I put this in a ratio, 500 divided by 3,000, 16% and 10%. So what is happening? The moment I put in ratio, right, the underlying nature, what is underlying nature? It is in terms of rupees, right? That is gone. And also the size or the quantum is also negated. The moment you put in this, so no more it is 3,000 or 5 lakhs, no more it is 500 or 50,000. You're telling my profit ratio is 16% and my profit ratio here is 10%. Able to follow? Right? So that is the benefit of ratio analysis, right? And what it is a representing two different numbers or variables, okay, relative to one another, one on another, numerator, denominator, okay. Why? Because it reduces the effect of, it negates, not reduces, it negates the effect of quantum, it negates the underlying nature of the data itself. Right? So why ratios? Understand before we get into expressing the ratios. Okay, point 1 of ratios. Okay, what and why. Then ratios are features of ratios. Ratios are a trigger point. They tell what has happened. They are trigger point and not a conclusion. Right? I cannot conclude here by telling that company B's profitability ratio is 10%. It is less than company A, hence it is not good as company A. I cannot do that. I can say yes, B's ratio is 10% less compared to A, full stop. I cannot go and conclude that A is better than B. Why? Because there are a lot of other factors I have to look at. There is only a first point. It is a trigger point to find out what has happened and to find out why it has happened. They tell what has happened, but they will not tell. They will not. Okay? They will not tell why it has happened. Getting it? All those who are doing your professional courses, this is, I have told, this is one chapter. ACCA, CFA, this is one chapter in your ACCA also. In your financial reporting paper, there is something called as interpretation. I'm not going to do it separately. I will then later link it half an hour. Okay. So CFA students also, you have your this thing in your FSA. Okay. So they will not tell why it has happened. Yes, any doubts? Why they will not tell? Why? Because it is a mathematical representation, right? It only tells this is a calculation, right? Now whether this is less or not, why this has happened, why this is higher than this, just looking at it, it will not happen. You will not be able to identify. You will need more information to find out why it has happened. So it is not a conclusion. It is only a starting point. It is a trigger point. They will not tell why it has happened. They will tell what has happened or give an indication of what has happened. Okay. Then a point coming from second point is, hence we cannot look at ratios in isolation. Hence ratios cannot be looked at in isolation, meaning to say I cannot look at one ratio and conclude about the company using that one ratio. Getting it? Hence ratios, I cannot look at one ratio and say, okay, this ratio, because of this ratio, company is good, company is not good. Right? You have to look at it comprehensively. All the factors you have to look at it. All right? Any doubts? Did we understand? So what are ratios? They represent the numbers, underlying nature, percent, rupees, dollars, kgs, whatever is a attached attribute that is negated. What finally you come at around is only in terms of percentage and in terms of times. It is a trigger point. It is not a conclusion, right? Hence ratios cannot be looked at in isolation. And the another factor is basically, if you are doing financial analysis, right, then your financial statements, right, we talked about in terms of P&L, balance sheet and cash flow, right? What is cash flow? It is a statement of attribute. It is a statement of feature. I'm talking about feature. Cash flow. I said P&L and balance sheet are statements of dash, and cash flow statement of dash. Statement of facts. Cash flow is a statement of facts. P&L and balance sheet are statement of accounting. Then few more points I told. What are the points? Huh? That is cash flow. For P&L and balance sheet, I told few more points. Features. Huh? Impacted and influenced by management. Impacted and influenced by the accounting choices of the management. Right? So that means P&L and balance sheet, the numbers are impacted and influenced by the accounting choices of the management. Then ratios will also give a result based on that only. If your P&L and balance sheet numbers are influenced by the management, your ratio analysis will also give the similar result. So you have to be careful about what numbers you are working on. You should understand the numbers, right? And many times, whether they are negatively influenced means what? It is not that profits have been reduced or profits have been increased. Negatively influenced means management has tried to influence the numbers unwantedly, right? It was not required to influence, but they have done it deliberately. That picture may come out many times in the ratio analysis. Okay, all right. So now, basically, we wanted to understand what are ratios. Now, go through these financials. We will be using only two tabs of this particular sheet: ratio analysis and financials. Okay, only do these two tabs. These other tabs we are not going to use it. Okay. Now, if you look at the financials, this is the vertical format. This is generally the reported format. 4 years of financials are given: 16, 17, 18, 19. Okay, we are going to do the analysis for these 3 years: 17, 18, and 19. Okay, we are going to use the financials of these 3 years: 17, 18, and 19. Okay, only this tab you are not going to do any changes to this tab. Okay, all our calculation we are going to work out is in this tab. Okay, and you are not going to use any of this data. You are going to look at only the financials tab. Okay, now I'll give you 5 minutes. Go through this financials fully. See what is there in it. Understand what is there in it. See what are there in the numbers. All of you have got the file? In the group it was shared. Shared in the WhatsApp group. So this is about a company, okay, a paint manufacturing company, Berger Paints. Okay, they have given the P&L. Now this is the format of the P&L, like the same format which we saw similar, but detailed one. Okay, so detailed financials will be like this only. Okay, so they have given some numbers along with some percentages also. Revenues are given. Then this is total cost, gross profit is given. Then indirect cost, okay, or you can say administrative cost they have given. Okay, and then your operating profit before depreciation, operating profit, finance cost, any other income, tax, and net profit. Okay, balance sheet is also given, source of funds, equity capital, debt, total funds employed, liabilities, and then assets also. And then there is some additional information is also given. Okay, have you got the file, everyone? Okay. Selling, general, and administrative. Okay. So now the first thing that we do whenever we look at any financials, okay, for the purpose of financial statement analysis, anyone, irrespective of who is doing it, will invariably look at What? Tell me, what will derive everything in a business? Say expenses. I need so much of expenses. I need to incur so much of expenses. I need so many of employees. I need so much of infra. What will derive all this? My capability of earning, generating revenue, right? If I cannot generate so much of revenue, or if I'm not generating X amount of revenue, then I cannot have proportionate expenses. I cannot have no point in having proportionate infra. So the first thing that anyone will look at is revenue. Your revenue will determine everything else. You may say that without having assets, how will I derive revenue? Yes, you may have assets, okay, but that assets can derive only so much of revenue, right? If you want more revenue, you have to increase your resources, right? If you can do only so much of revenue, then no point in having so much of assets, right? That means in any business, everything is a function of revenue, right? So first we look at what has happened to the revenue, okay, whether revenue has gone up or not, okay, calculate the revenue growth. So growth calculation you have learnt in Excel when Excel class was done. Calculate the revenue growth of this company over the 3 years. Okay. Calculate it. Arun, Vyanjana calculating.
Yes, sir. Hello. Don't use calculator when you have Excel. It is an insult for Excel. So using calculator is like something good on how to put that is like going to Kutralam there and taking a bath in the hotel room, then going and watching people. Yes, what is the growth? How do we calculate it?
So look at this. I know most of you are struggling because you have not done it previously. Current year revenue is 100. Next year revenue is 120. So how much is the growth? 20%. How did you get this? 120 minus divided by 100 or 120? 100. So have you done the same thing for this? Can you do the same thing?
Done, sir.
Yes, what are the numbers?
Sir, for first year it's 6.8%. Second year 14.6%, and third year 16.8%.
Okay. Done? So look at this. There are 2 or 3 ways to do it. Current year revenue minus previous year revenue. Okay, you have to close the bracket. You have to put it in bracket. Then this whole, look at this, look at this, look at this. When I am talking, you are supposed to listen. This divided by, okay, Excel also goes by Bodmas rule, mathematics, right? Minus, plus, what comes first. So Excel also will work on that only. So you have to be careful when you are entering the numbers, and especially when multiplication, division, everything is coming together. You should use brackets properly. So previous year, that means current year, which is D7 minus previous year number, the whole divided by previous year number. This is one way to do it. Okay. And Excel is little advanced. You can also simply say current year number divided by previous year number. And what you will do? Minus 100, instead of 100, you will say minus 100. So this is also percentage. It's just that the format is not in terms of percentage. You have to increase the decimal and put it in the percentage format. Okay, so 2 ways: current year minus previous year, the whole divided by previous year, or current year divided by previous year, the whole minus 1. Either of this you can do. Okay, so this is easier relatively. This current year divided by previous year minus 1. Okay, and then copy this to all the 3 years. Any doubts? Done? Okay. So what does this indicate? So they're telling the growth is 7% in first year, then 14.5%, then around 17%. What does it mean? It's growing by what percentage? So let's say it was 100, then it became around 107, then on this around 14%. Right, then the revenue became 121. Then on this another 17%. Right, that means my revenue has been growing. Right, first thing is revenue is growing. Okay, how is revenue calculated? How do you calculate the sales? Cash. Is cash important?
Cash is cash is plus. And the product or product is
Credit.
credit.
Why should credit? Is credit necessary? So credit or cash point should not even come. When the sales happen, product is sold. Okay. My point is, what will cause the revenue to grow? How does revenue grow? When you sell the goods, that I know. It was 100, then it became 107. Right? That is what? It was 100, now it has become 107. Last year I sold goods worth 100. This year I am selling goods worth 107. Right? What is causing this difference? How 100 has become 107 calculation wise? When will revenue increase? That here also I am selling. My question is, when will you increase? When will it increase? Are we looking at profit here? Yes. Huh? Sales is? How will the sales be more? That's what sales is more. I am telling. What are you telling me again? Very simple. What will cause my revenue to grow? Huh? Very good. Increase in customers means increase in demand means madam what? Huh? Means that's right. Why cost of where we are not even talking about cost here. We are talking about revenue. What will cause my revenue to go up? It is very simple. Okay, how do you calculate revenue? How is it calculated? Think. How is revenue calculated? What is this number made of? I am telling this is the value is 100. Okay, this 100 is calculated by doing what? How is the calculation done for this 100? Where is cost of? Why are we even talking about cost of goods? I'm talking about revenue here. 100 has become 107. How did 100 become 107? One class, one fellow told me, sir, you only wrote 107. How has 100 become 107? Due to sales. Here also I am doing sales only, no? What is the difference between these two? Huh? More demand. So sale has increased. So what has happened? So sale has increased means what has happened? Revenue is growing, I know. Sale has increased means what? More what? More is correct.
More people know about the product.
No. I'm not talking about the cost. I'm talking about the result. More production. So more demand. So more goods has been sold. More sales. So more volume. Volume has increased. So if I tell you now, volume has not increased, but still this has increased. That means what? You are selling at higher price. This could go. You are selling at higher price. How do you calculate sales? Revenue is equal to what? Sales volume into price, right? Rate into quantity. So if my revenue is increasing, either my rate is increasing or my price is increasing or the volume is increasing or both are increasing. Getting my point? When will my revenue grow? When either my volume should go up or my price should go up, or both can also go up. But at least one of these should go up. So if my revenue is growing, okay, so what can happen? It could be because of higher volume, okay, or higher price. Okay, so I am trying to find out what has happened. Are you getting it? I'm not trying to find out why it has happened. First, let us find out what has happened. Revenue is growing. Why is revenue is growing? It's very, very clear that either volume is growing or price rate has grown up. Right? Now, why will volume go up? Why can demand is more? When will demand be more? When will demand be more? When price is less, right? But price is also growing here. When people want to buy more, right? But why are they buying from you? That is the question now. Because of your branding, better. Good. So better branding, better quality, okay, better probably discounts, right? Or more marketing. Sales can grow because you have incurred very high marketing cost. Right? We are only trying to guess. This could be anyone's guess. Unless I go and see the financials properly, unless I go and read the notes to accounts, unless I go and find out more about the company, I will not be able to know. But here I'm trying to list out what are all the possibilities. Okay? Not an exhaustive list, but an indicative list. I'm not telling only because of this revenue will grow. Yes, this is for sure. This is mathematics. Revenue is growing because of volume or price. But why is my volume growing? My volume is growing because I am giving a better quality product, or I am doing marketing, or I'm offering here and there little discounts, or can anyone tell any more reason? Reputation, branding. What could be any more reason why you are able to sell more? Any other reason why do you think my sales could go up? Yes, Varun? Why could sales go up? Apart from these reasons. Hmm. Increase
Sir,
in
maybe
production.
the
Just because you produce, you will sell. Yes, Varun?
sir, if the price of the goods are reduced, then there might be more sales.
Okay, good, fine. Any other point? Just because you produce, will you be able to sell?
Sir, more and more
Is it in my
advertisement.
hand? No. More advertising, more marketing that I've done. Any other
Yeah.
reason? Season time. What was the season was not there before? Only now. Last year also season would have been there, right? Emergency. What emergency?
They've opened and they've reached new places.
Expanded. Expansion. Good. Then anything else? Expansion is a good word. Okay, I do not have this in mind. Expanded. My store has become bigger, or have more branches. That is also a possibility. Anything else? Like.
Whatever new product comes or
Hmm.
whatever the trend has become more.
So better branding, quality, marketing. Okay, expansion, new products, expansion. One more reason. See, this is like, I will not be able to exhaust all the reasons, but broadly, we are trying to discuss what could be the reason why revenue will grow. Service have better quality, product quality or service quality, whatever it is. Yes. Where? Warranty, okay, better branding, okay, I can say additional features, that is also good. Giving additional features for warranty or any other add-on. Buy 1 month Netflix subscription, get 3 months free. One important point still missing. I am offering more on credit. Right? If I give on credit, a lot of people will buy. Right? Now these things, this could be positive things, this could be negative things. This may be genuinely boosting your revenue, or just to get more market share, you're doing all these things. Marketing, more credit. Right? So we are not trying to conclude here, we are telling it could be because of these things. How will you be able to conclude as we progress further? As you go and look at the financials more, you will be able to, little bit, will be able to identify it was because of what. Okay, now for example, better branding means what? Marketing cost will increase. So when we come to cost, we will see whether marketing cost has increased. Okay, manifold. Okay, better quality means what? Better quality, where will it come?
After service charges.
Material cost. So material cost will reflect where? Production, cost of goods sold, right? Cost of production, cost of goods sold. If your cost of goods sold is increasing, probably this could be a reason. There are other reasons, okay? Better branding, quality, discounts. Where will it reflect? In income statement, where will it reflect? Profit, it will ultimately reflect everything. Discount will reflect in revenue only, right? Because you are doing more volume here at a lesser price, your revenue is increasing at a lesser pace. Okay, expansion, where will it reflect? Assets will increase. If the assets increase, and correspondingly, which expense will increase? If assets increase, which expense will increase? Huh? Depreciation will increase, probably. Okay, additional features means additional cost. More credit, where will it reflect? In receivables, sundry debtors. Getting it? Right? So that means you cannot conclude simply, you will have to look at everything. Able to understand? So this is not an exhaustive list, this is only an indicative list. There could be 1,000 other reasons why my revenue is growing up in terms of volume. Right? Okay. So first thing that we are looking at is profitability. We look at profitability. Okay, and income statement. And we have now, let us assume will be positive and we'll say that company is doing well, revenue is growing. Okay, and we'll try to see whether these things are happening, whether unnecessary marketing is being done, whether marketing costs have increased significantly, but sales have not increased as expected. For the amount of marketing that you are doing, whether are you getting similar amount of sales, right? We call this as conversion ratio. Okay, conversion ratio, like how much you are spending and how much of that is getting converted. Okay, we are not going to use that here. We are doing financial statement analysis. Okay, so now one feature of ratios, okay, good that this point came up, is every industry, okay, every company will have different ratios for themselves. What we are learning is for the general purpose financial statements we are learning. As I said, it is not that all of us are going to become equity research analysts, right? But definitely all of us are going to be working in finance. So let's say if I am working in a company which is manufacturing these projectors, right? The ratios that I'll be looking at will be totally different. A bank, when I am analyzing a company which is a bank, let's say I'm analyzing HDFC Bank or Axis Bank, right? The ratios that I'll be using will be totally different. And when a bank is trying to evaluate a client for a loan purpose, the ratios that it will look at in the client's financial statements could be totally different. Right? Through this exercise of financial analysis, ratios analysis, our objective is, it is not only to become masters with this, but we also be able to understand how to apply a ratio, how to do an analysis. Okay, so that tomorrow in the context of an interview or on the job, when you are given a report to analyze or if you are given a report to prepare, right, based on the business that you are working on, okay, whether are you able to interpret or are you able to give metrics which are relevant for your business. For example, if I'm working in a marketing role, can I work in a marketing role? Yes. Can a finance person work in a marketing role? Finance person can work, has to understand all the functions. Let's say I am a finance person and my company is incurring marketing cost. Okay, some new marketing campaigns have been done, heavy marketing budget has been allocated, right? It is a responsibility of the marketing director or the marketing head to make sure corresponding sales is happening. Fine, that marketing campaigns are effective. However, who will tell the management that it is effective or not? The finance guy. The finance guy has to find out last year with X amount of marketing, we are able to achieve so much of sales. This year we have done Y amount of marketing cost. Whether have we got corresponding sales? Is this a ratio? This is a ratio. Marketing cost on revenue, or revenue to marketing cost, whichever way you want to calculate. Are we going to discuss that ratio here? No. Right? We are not going to do. But this is done in real life very much. Every company does it. Every company which incurs marketing cost will have to do it, does it. Getting it? Okay. Let's come to this. All right. So in terms of profitability, we are trying to understand the profitability of a company, right? As to how the value addition happens. Right? We wanted to understand what does your income statement give? We know that it gives the financial performance and the value addition. So how this value addition happens? How the value addition is happening, right? For example, if I tell you that net profit is this and revenue is this, can I understand properly that how this profits came? No. I wanted to know how this profits came. Right? For that purpose, we try and understand more components of the P&L, try to find out how this profits came in, or how this losses came in, or how this profits increased. So for that purpose, the first thing that we do is we try to calculate gross margin, gross profit. Okay, gross profit divided by what? Revenue. Okay, gross profit divided by revenue. What it tells us, first you calculate, then we will see. Calculate gross profit divided by revenue for each of these 3 years. Gross profit is given, revenue is also given, calculate. Calculated gross margin. How much is the gross margin? Got it? Okay. Now tell me what has happened to the gross margin? Why it has reduced? It has reduced, decreasing trend. So if now look at this, gross margin is reduced. Gross margin is made up of what? Gross margin is calculated as gross profit divided by revenue. We are telling this ratio has decreased, right? That means numerator has decreased or denominator has decreased. Okay, numerator has decreased and denominator has increased. Do we know whether it has increased? We just concluded that revenue is increasing. Right? Revenue is increasing. We have just understood that. So we know that revenue has increased, denominator has increased, then obviously if gross profit is not increasing, the margin will decrease. That means numerator has decreased. That means gross profit has decreased. Gross profit is made up of what? Gross profit is equal to what? Revenue minus COGS, okay? Minus COGS. Now we know revenue has increased, right? This has increased, then COGS has what happened? This is down, GP is down. We know that gross profit is down. Do we know that it is down? Is it down? It is not down. It has increased. Gross profit has increased. Then how are we telling gross profit is down? Gross profit rate is down. Okay, now revenue has increased, COGS has increased, right? So now what it means is, even though my revenue has grown, even though my gross profit has grown, right, the rate of growth in numerator, okay, is less compared to the rate of growth in denominator. This is mathematics, right? The rate of growth is in numerator, which is my gross profit, has reduced. That means, and when we know that revenue has increased, that means what? My costs have increased more than my revenue. If revenue had not decreased, if revenue had not increased, then it's fine. But it is confusing here because my revenue has also increased, but my gross profit margin is decreasing, meaning to say my costs have increased. Okay? Why costs have increased? So we now know that decreasing trend indicates costs have increased. Okay? Which costs have increased? Which cost has increased and why
Direct
it has
cost.
increased? Which one?
Maybe direct cost has increased, manufacturing cost.
So no, direct cost, why they have increased? Producing more means you are selling also more, right? Purchase is more. No? Why will you purchase more? You are purchasing more, you are selling more, right? Check, the answer is in that financials. Material? What is that material consumption?
How much raw materials are producing?
Okay, right. So material consumption has increased. What is material consumption? It could be you are using more quantum to produce the same unit, or the price of raw material has increased, right? the costs have increased, the cost of your inputs, which are raw materials, they have increased, or what could be the reason?
You're using more products, adding more features to the same product.
You are adding more features, your quality has increased, probably, right? So decreasing trend indicates cost have increased, okay, mainly due to material consumption, that we can see. Okay, now how I am concluding that it is mainly due to material consumption? Can I conclude it like that? Can I conclude it that my gross profit margin from 50% to 45%, it has become like it has come down by 5 to 6% because of material consumption? Can I conclude? What is the way? Is there a way to conclude? We can try and find out. What will I do? What I will do is I will try to keep my material consumption rate same. Now look at this. I will do it. This is called trial and error approach. You don't have to do it. I will do it. So remember these numbers. What are your margins? 50, 48 and 45. Okay. Now what I am going to do is I am going to keep this constant and then see whether my margin is similar. So this is equal to this into material consumption rate and keeping constant. Okay, whatever proportion, like earlier for, let's say, for 100 rupees revenue, I'm using material of 20 rupees. For 150 rupees revenue, how much material I should be using? How much? For, for 100, I'm using 20 material. For 150, how much I will use? 30. Right? So the same thing. So for 4122, I'm using 2111. For 4724, by this ratio, I'm going to use this. Now let me see what is happening to my ratios. It is more or less similar. That means I can conclude it is because of material consumption. Right? This is clear. Mathematically, this is clear. Now I'm going to go back to my same numbers. You see, how did we conclude? To find out whether this is a cost, we can always do this trial and error approach. So decreasing trend indicates costs have increased mainly due to material consumption. Now the question is, what would have caused material consumption? So we have told here what has happened is material consumption has increased. Okay, so decreasing trend mainly due to higher material consumption. Now the question is, what would have caused my material consumption to go up? For that, okay, which could be because of higher quality materials or material costs incurred. Material costs increased, sorry. Same material you are using, but material cost increased. Then what could be the any other reason? Any other reason? As to why my material consumption has increased. Could be because of production inefficiencies. Right? There is some problem with my machines. Right? Production inefficiency. What else? Right? It could be because of any of these things. We are not trying to conclude. That is why I said which could be because of A, B, C, D reasons. Right? This is your interpretation of ratios. Following? Did we understand? material consumption. Okay. So now, what does gross margin tell us? Generally, we have analyzed here, but what does it tell? What does gross margin tell? What is gross margin? What is gross profit?
Before including indirect expenses.
Same thing, no? Direct expense or without indirect expense. What does your gross profit tell? Okay, correct. But to put it in more analytical way, okay, gross profit tells me what is the portion of revenue that I am retaining. Okay, after accounting for the core costs in providing the service, relevant service. Core cost, direct cost, invariably it is direct cost only. But more analytical way is that portion of revenue which I am retaining after accounting for the core cost of providing the service. For example, if I am selling the laptop, if I am a laptop dealer, then and I am telling my gross profit margin is 50%. That means I am selling my laptop at a 50% gross profit margin. Laptop is price is 50,000. I am getting it for 25,000 or say for 25,000, 35,000, 50% profit, right? So 35,000 or 34,000. My cost was 33,000, 34,000. I'm selling for 50,000, which is 50% margin. Right? Purely the core cost in terms of providing the service. Right? The core cost is the laptop. Okay? Gross profit. Then operating profit margin. Okay, which is basically EBITDA. What is EBITDA? Earnings before கோரஸா சொல்லலாம் இதுதான் ப்ராப்ளம் earnings before India, Tokyo, Delhi and Andaman Nicobar. அங்கேயே போயிடலாம். Where is I? Why did it become income tax before? Okay, earnings before interest, tax, depreciation and amortization. Why do we look at this? What does it tell us? What does it tell us?
All the direct and indirect taxes are accounted for. What is the profit?
Okay, now look at this. Very, very important. So two companies, company A, company B. Assets required 10,000. 10,000. Company A takes equity 10,000. Loan is 0. Company B does this. Okay. Now tell me, just because it is like this, will there be any difference in the way they provide their service? Will there be any different in the product they are manufacturing and selling? Right? That means the way I raised my capital should not have any impact on the way I am doing my business. Correct? Now, as far as this fellow is concerned, B, for debt, he will have to have interest. Right? So let's say now we'll do a small P&L here. Revenue, let's say 5,000. 5,000. COGS, 1,000. What will come? Gross profit. $4,000. Okay. Other operating costs. Say 1,500. This is called as operating profit. 2,500. Now interest 0. Let's say 10%. 500. Okay, so this is PBT, profit before tax. 2,500, 2,000. Let's say 20% tax. 500, 400. What is causing this difference? Okay, so if I look at net profit, it will look as if B is not efficient and A is efficient. But everything is same. Right? So I cannot look at net profit. To assess the core operating performance. These two are entrepreneurs. I wanted to assess their capability of doing a particular business. Right? So I cannot assess based on this. I'm trying to find out how good they are in running a particular business. Are they good enough? Right? For that, to assess the operating performance of any company, we look at operating margins, we don't look at net margins. Yes, ultimately, I'm not telling, see, when I'm doing this discussion, when I'm talking about one metric, it doesn't mean that other metrics are not important. Right? Our entire focus is to understand what is the significance of a particular metric, and we are going to do one by one. Okay, so my operating performance cannot be assessed through profit after tax. Why? Because it is impacted by financing cost. It is also impacted by tax. Now let's say entrepreneur A is in a country where there is tax rate is 20% and B is in a country where the tax rate is say 30%. Then that will also cost now 20% or 30%. Is it in my hand? It is in government hand. Right? That entrepreneur or that business cannot do anything about it. Right? So for me to assess their performance, I look at this section. Getting it? Able to understand why operating performance or why EBITDA? Interview question. Okay, interview question சொன்னாதான் கை ஆடுது இல்லைன்னா ஆடாது. EBITDA margin, EBITDA divided by revenue. Now many times operating profit we also say EBIT. Okay, so it again depends upon the view that you are taking, whether you want to consider depreciation or not. Right? So if you want to consider depreciation, you will take EBIT. If you don't want to consider depreciation, you will take EBITDA. Calculate this and tell me what is happening to the operating profit margin. Done? Calculated margins. What are the numbers? So what is happening to operating margin? Why it is reducing? So is that causing the dip? Why is operating margin decreasing? Yes, what is causing the margin to go down? The first thing is, even without looking at it, you have to tell it is mainly because of above reason. Which is above reason? This reason. Because this will impact this or not. Right? So, mainly due to higher material consumption highlighted above, and any other reason is this is causing. Okay. Now let us find out. Let us come to the indirect cost section, which is this section. Right? How do I conclude that it is because of miscellaneous expenses? First thing, let me keep material consumption constant. Again, I will do the same thing. Right? I have kept material consumption constant. That means that material consumption is nullified. The impact of material consumption is nullified. Okay, for now. But still, this is coming down. So we need to find out what is causing this dip. Okay, run through the numbers. Okay, tells us that it could be because of the miscellaneous expenditure. Other expenditures have not increased much, right? And obviously revenue has not come down. We have seen it. So now what I'm going to do is I'm going to keep this miscellaneous expenditure also relatively constant. What I'm going to do here is equal to revenue into previous year's ratio, previous year's proportion. Like previous year, the miscellaneous cost was 29% of revenue. So I'm trying to keep that this year also. Like I'm trying to keep this year also, my miscellaneous expenditure will be 29% of my revenue. Then I go to the ratios and see what is happening. Right? It is now relatively constant. There is in fact, marginal increase. There is a marginal increase in my operating cost. Okay, probably because I've nullified this and because my profitability is also increasing. Right, my employee costs are insignificant, they're remaining more or less same. Right, only two items we are talking about here: miscellaneous expenditure and employee costs. Right, so yes, this is because of your miscellaneous expenditure. Now I'm going to go back, restate the numbers. Okay, mainly due to higher material consumption highlighted above and miscellaneous expenditure increased proportionately compared to the previous year. Now, what is that miscellaneous expenditure? Why it increased? That information we do not have. Obviously, in the real-time financials, it will be mentioned. It will be given in the notes. Okay, and if there is any exceptional item, it will also be mentioned. With the given information here, this is the interpretation we can do. We know that it is because of mainly the material consumption, and when it comes to operating profit, that there is something called as miscellaneous expenditure which has increased. Getting it, everyone? Interpretation is more important. Calculation is fine, but more important is interpretation. Okay, can we calculate these two? Pre-tax margin is what? EBT divided by revenue. First calculate EBIT. EBIT divided by revenue. This is also more or less operating profit only. Similar will be the impact. Calculated pre-tax. Interpretation, pre-tax and EBIT margin. EBIT margin changing. Similar is the margin.
Margin is similar, but it's reducing as to basically.
Varun, following? Varun, Vyanjana? EBIT.
Yes, sir.
So EBIT, what is the interpretation we can give?
It's related to previous reductions and increase in costs.
Then EBT, we'll do EBT also first. EBT post other income. Okay, you will take other income also. Now, if you look at what is making, we have analyzed it till this part, right? Now there are only depreciation. Is depreciation changing much? It is not changing. Even otherwise, it is a small number. In fact, depreciation has reduced. It used to be 2.4%. Now it is 2.2%. So this is not going to cause any major uh, change in the profitability. Interest costs are also very, very insignificant in your case. Okay, these are very, very small, even though interest cost is increasing, but it will not have any major impact. So we are not going to look at other income is also more or less same, right? There is no much of change. So we'll tell the interpretation is same. Mainly due to higher material consumption and miscellaneous expenditure. Okay, we have done this, then finally calculate net profit margin. Yes, net profit margin. Okay. Now what has happened to net profit? It has become negative. Why?
Last year, 29, costs have increased.
Hmm. What is the interpretation for net profit?
Tax rate will increase. 2018 is 39.
The tax last year, 290.
So, how does it matter? Why is your net profit negative? Net profit margin is negative. Why is your net profit margin negative? Earnings is less. Earnings is less than what? Tax. Where? Where? What is less than what? Hmm. So now look at this. First, let us find out whether these are the reasons causing my net profit to be negative. So for that, what I have to do is I have to keep them again constant and check what is happening to my, whether are these indeed turning my net profit negative, or is there any other reason. So miscellaneous cost, okay. So I've kept whatever was the, because whatever is the impact here, this will obviously come down here, right? Whatever is the impact here, this will obviously come down here. Now if you look at it, right, in fact my net profit margin has increased. Right? So that means what? It means it is mainly because of these only. Okay, mainly because of material consumption and miscellaneous cost. Okay. However, when I run through the financials, my eyes are focused here. My attention is coming here. Why? Because for a profit of 579 million or crores, I had paid a tax of 230 crores. And here, for a profit of 130 crore, I'm still paying a tax of 253 crores. Right? Are you getting my point? So, what is this causing? Why is that I'm paying a higher tax? And that is showing up here in terms of effective tax rate. What is ETR? What is effective tax rate? Is tax divided by what? Tax divided by what? Check how they have calculated ETR. Profit before tax or EBT. Okay, tax divided by EBT, ETR. Okay, now your tax in the books will not be a simple calculation of EBT into tax rate. Whatever is the tax rate prevalent. Okay, it will not be like my EBT is 100, so my tax, my EBT is 1000, my tax at 25% will be 250. No. Why? Because the way tax is calculated, there is a law to it. Okay, the way it is done is totally different based on income tax regulations. Okay, there is some, when we come to deferred tax, I will explain this. When certain expenditures are not allowed as expenditure and certain income is not taxed, okay, all those reasons will cause the tax calculation to be totally different. Okay, so it is not a simple calculation of EBT into tax rate. Hence we find out a metric called as effective tax rate. Okay, effectively how much tax you are paying. So effectively I am paying tax upon EBT. So here we are telling that I am paying an effective tax rate of 195%. Now it doesn't mean that in 1 year government's tax rate was 39%, now it has become 195%. This is not logical. This is your effective tax rate, meaning to say you are paying tax almost 200% of your income, which is true here, right? 130 was your income and you are paying tax of 250. So that is why your ETR is more. Okay, so you will add one more point. Mainly due to above, plus very high tax paid, not tax paid, very high tax expense proportionate to the EBT. Okay, this is the fact. Mainly due to above plus very high tax expense proportionate to the EBT. Okay. Now, this could also be, why is someone paying so much of tax? It could be, I feel, it could be because of that miscellaneous expenditure. Right? Because when we removed that miscellaneous expenditure, higher miscellaneous expenditure, right, the tax rate became normal. It could be because there could be some miscellaneous expenditure. You have incurred some expenditure which is not allowed as an expenditure by the government. It could be that miscellaneous expenditure could include, say, some penalty. Okay, you have violated some law while you are doing your business. So government has imposed a penalty. You paid that penalty, but you have not. That is not allowed as an expenditure by the income tax authorities. So what they have told, you have incurred this expenditure, will not treat this as an expenditure, right? So you will have to pay tax on a higher amount. So if you look at it, you are paying tax, your tax rate or the amount of tax that you are paying is proportionate to the previous year, but it is not proportionate to this income. Why? Because this income is down because of that higher miscellaneous expenditure. Right? So this could be a possibility why your tax rate is high. It is anyone's guess only. Okay, my guess is here, this miscellaneous expenditure would have included some item which is not allowable. That is why you are paying higher tax. Okay, now we are not going to write that, but that could be a possibility unless we go and find out in the notes to accounts. Unless we find out more information, we will not be able to know. Okay, plus very high tax expense proportionate to EBT, probably because of the miscellaneous expenditure, okay, not being allowed as tax deductible expense. Getting my point? Probably because the miscellaneous expenditure is not allowed as a tax deductible expense. Probably. So I'm not concluding here. Probably. Clear? Did we understand what is happening here? So this is how we have analyzed. So what we have tried doing is we are trying to compare the profitability of the company. Okay, we are telling the profit, net profit is at a high level. Anytime when you look at it, we'll first look at net profit only. And here, when we are looking at net profit, it looks like company has done incurred losses. Right? Yes, company has incurred losses because your net profit margin is negative 2%. You have incurred losses, no doubt. Why you have incurred the losses? What has caused this loss? For that, we are doing this interpretation one after another. We are looking at each component, right? Here you have only told what has happened. Okay, we have not gone and found out why it has happened. Okay, that exercise is a separate exercise where you have to work with the company's information, notes to accounts, you have to understand the industry, you have to understand the company background and figure out, okay, what will be my next step? My next step will be to look at other companies in the similar industry, in the same industry, say Berger. So I may look at Asian Paints, I may look at other companies and find out what is their material consumption rate. Right? Obviously, that miscellaneous expenditure, I cannot say what is their miscellaneous expenditure. No. Miscellaneous expenditure, I'll try to figure out from this company's information, notes to accounts only, what is this miscellaneous expenditure? Why they are incurred? right? And what is the tax treatment of that? So I'll try to figure out the tax treatment also. Getting it? So I'll try to compare what you've done. I've compared myself with previous years, right? This is the first step. Then now with this, I know that, okay, in this company, because of material consumption, profitability has come down. Let us look at what has happened to the industry in the previous year. In the entire industry also, material consumption has increased. Yes, then okay. Otherwise, why this companies has increased? That we said it could be because of higher quality of materials, higher cost of input, better quality, production inefficiency, XYZ, lot of reasons. Getting it? Okay. So we'll do one thing. We'll take a break and come back and then continue with the return ratios.